Well, good evening, everyone. Thank you so much for joining us tonight. My name is David Hebert, and I'm going to be serving as the moderator for tonight's discussion. Trump has been president for 100 days once again. Joining us tonight will be Dr. Samuel Gregg to discuss the impact of those first 100 days. Now, Samuel Gregg is the president and Friedrich Hayek Chair in Economics and Economic History at the American Institute for Economic Research. He has a doctorate in moral philosophy and political economy from Oxford University and a master's in political philosophy from the University of Melbourne. He's the author of 17 books and over 700 articles and opinion pieces, and a member of the Royal Historical Society, the Mont Pelerin Society, and the Philadelphia Society, where he is both a past president and distinguished fellow. Finally, in 2024, he received the prestigious Bradley Prize, which goes to scholars and practitioners whose work seeks to restore, strengthen, and protect the principles and institutions of American exceptionalism. Please join me in welcoming Dr. Samuel Gregg.
Well, thank you very much, Dave, for that kind introduction. I'm very glad to be here this evening and to extend my welcome of all of you who are watching to AIER as we pursue our ambition to be the nation's premier classical liberal institution and to advance the ideas and policies of liberty, free markets, and, of course, limited government. In advancing these ideas, we do research, we educate, and we communicate, especially when it comes to our three priority areas, which are economic policy, monetary policy, and our work in pushing back against the new forms of collectivism that, alas, are now coming from across the political spectrum in America and elsewhere. AIER is all about ideas, but we're also about operationalizing those ideas because we want to bring them to thinkers, to policymakers, journalists, students, and perhaps above all, the everyman that Colonel Harwood, our founder, was so concerned about. Our Harwood Salons, such as the one we're doing tonight, bring together local community leaders, thinkers, and we do this virtually and in cities around the country to articulate our ideas, to discuss complex economic topics, and to make them accessible and relevant to everyday life. At the end of this presentation, we'll tell you more about how to learn about participating in a Harwood Salon near you. And of course, our mission and this is made possible by the generosity of private donors. So thank you very much to our donors who are watching tonight. Well, as Dave said, this week marks the 100th day of President Trump's second term. It's a benchmark, of course, that's widely considered the first impression of any administration. Now, this artificial but enduring milestone, of course, has its roots in the presidency of Franklin Delano Roosevelt. Because within months of taking office in 1933, he signed many bills and executive orders that set the New Deal in motion, and in many ways, paradoxically enough, was responsible for the creation of AIER. Now, Roosevelt's first 100 days were so energetic that presidents have been evaluated at every point ever since then. For their early accomplishments are looked at, but also their missteps in this 100 days. Now, of course, there's only so much 100 days can tell us. After all, during Abraham Lincoln's first 100 days, the Union literally collapsed during that period of time. And yet many today view him as being one of America's greatest presidents. And while the first 100 days don't necessarily determine the rest of a president's term, they often foreshadow priorities, achievements, and of course, problems that are likely to come. So in that sense, that 100 days can be a useful check-in point to see how a president's early actions are lining up with their campaign promises. Now, there's lots of things we could talk about when it comes to the Trump administration's first 100 days, but given that we are AIER and we do economics, I'm going to laser focus on economics and economic policy. But to provide some context, I think it's important that we quickly recall the first Trump administration's economic record and how it pursued an economic agenda that was centered on four basic things: tax cuts, deregulation, energy independence, and of course, a remarkable change in trade policy, away from trade liberalization and towards protectionist positions. So what were some of the successes of the first Trump administration economically? Well, it passed the Tax Cuts and Jobs Act in December 2017, which reduced the corporate tax rate from 35% to 21% and lowered income tax rates for individuals across brackets. Real GDP growth averaged 2.5% between 2017 and 2019, peaking at 2.9% in 2018. Now, this was above the 2.2% average of the Obama administration. Corporate tax cuts managed to spur forward business investment, with non-residential fixed investment rising 6.4% in 2018 alone. As for job creation, the economy added 6.7 million jobs between January 2017 and February 2020, and unemployment fell to a 50-year low of 3.5% in late 2019. Black unemployment hit a historic low of 5.4% in August 2019, while Hispanic unemployment dropped to 3.9% in September 2019. Women's unemployment fell to 3.4% in 2019, and that was the lowest ever in 65 years. Wage growth for the bottom 10% of earners rose 4.5% annually by 2019 and outpaced inflation. When it came to deregulation, the implementation of a plan of eliminating 2 regulations for every new regulation was put in place at the beginning. Now, I think here success was more modest, but it is also true that the growth of regulation largely stopped during the first Trump administration. As for energy independence, well, the Trump administration, under its watch, we saw oil and gas production expand, making America the world's top oil producer by 2018. This was achieved by things like approval of new pipelines, streamlined environmental regulation, and a speeding up of the approval process. And we saw much of the fruits of this in the stock market performance. The S&P 500 rose 50% between January 2017 and February 2020, and that boosted 401ks and pension values. The Dow Industrial Jones average hit a record 29,551 points in February 2020, and that, I think, obviously reflected investor confidence. Now, there were downsides. The federal deficit grew from just under $600 billion in 2016 to just under $100 billion in 2019. The national debt rose from $19.9 trillion in 2017 to $27.7 trillion by 2020. Interest payments on the debt increased 16% from 2017 to 2019. There were also problems with trade policy. As we know, the United States raised tariffs on China in 2018 on particular products, most notably steel and aluminum, and that led to retaliatory tariffs from China that hit farmers the hardest. It resulted in farm bailouts to offset tariff losses. Moreover, and more worryingly, there was no change in behavior from China as a consequence of these tariff increases. We saw a renegotiation of NAFTA, and I think it's fair to say that that produced modest benefits. So the first Trump administration's economic policies delivered, I think, tangible successes in the pre-COVID period in job creation, unemployment reduction, and stock market gains. But trade protectionism clearly disrupted markets, and it burdened consumers and farmers with higher costs. Rising deficits and debt posed long-term risks. And of course, the COVID crisis magnified many of these weaknesses. Overall, I think the economic record reflected a mixture of robust growth, but also missed opportunities, as well as structural challenges, like the public debt, that were left unaddressed. So that's some context, because I'm pretty sure President Trump looks back at his first administration in terms of economics with a certain degree of pride. But let's turn to the first 100 days of the second Trump administration. So what does it tell us? Well, there were, I think, some successes. I think this is particularly true in the area of deregulation. And maybe the most important of these deregulatory efforts has been the rollback of DEI. Now, keep in mind that DEI had been mandated as a whole government approach by the Biden administration. Now, there's lots of critiques, philosophical critiques of DEI, but I think from an economic standpoint, it's good to think about it as a form of labor market regulation. And that affected the entire federal government and all sectors of the economy in which the government was involved, during the Biden administration. So to the extent that DEI has been removed and repudiated by the Trump administration, it has certainly freed up the labor market insofar as the government's policies regarding things like DEI are no longer a factor that anyone doing business with the government has to think about for the foreseeable future. That's not the only deregulatory effort that's occurred. We've seen rollback in regulations across several sectors, most notably energy, but also the car industry and pharmaceuticals. And the effect has been to reduce compliance costs. So, for example, the easing of oil and gas drilling regulations and the streamlining of FDA approval processes has lowered operational costs, as has the easing of restrictions on liquefied natural gas exports and pipeline regulations. And that potentially could increase domestic energy production and reduce energy costs. There's also been a significant rollback when it comes to regulation associated with climate change. The Trump administration has withdrawn from the Paris Treaty, which mandated all sorts of commitments on the part of signatories when it came to climate change and climate change regulation. So if you're a US energy producer, you'd be very happy with that. Another part of the removal of climate change related regulation, at least part of it, has been the removal of EV mandates on car companies. And that's been very important as a deregulatory measure for the automobile industry. And then, of course, there's the Department of Government Efficiency, DOGE, led for the moment by Elon Musk, which has conducted extensive staffing reviews and engaged in targeted removals. The aim, of course, is to reduce the federal bureaucracy and to try and improve government efficiency. So in terms of broad numbers, we've seen a federal workforce reduction of about 125,000 jobs. That's approximately 6% of the total federal workforce. Now, according to figures published on Doge's own website, Doge estimates that it's cut about $160 billion from the federal budget. That represents about 8% of the $2 trillion that Elon Musk had initially pledged to save. Keep in mind that's 6% over a period of 100 days. So from that perspective, it seems that the Doge activity is having an effect. Moving away from questions of regulation, it's also clear that the Trump administration is trying to signal a certain degree of continuity when it comes to tax policy. So it has already started talking quite extensively about extending the 2017 Tax Cuts and Jobs Act, the object being to maintain the lower corporate tax rates as well as personal income tax cuts. And this, of course, if it goes ahead in later this year, if it's passed by Congress, this would stand to stimulate consumer spending as well as corporate profits. But as I said, we're going to have to wait to see what Congress ends up legislating and what the president is willing to sign. Another thing that the Trump administration has talked a lot about during its first 100 days is, of course, what it calls investment attraction. And the Trump administration says that it's secured about $1 trillion in what are called announced investments. And that includes $500 billion for AI development. Now, much of this is driven by the administration's aggressive rhetoric about incentivizing domestic production. So this is really President Trump doing what President Trump likes to do, which is doing deals. He likes to do deals with business leaders. He likes to preside over other business leaders doing business deals with other business leaders. But of course, the question overhanging this, if you believe in free markets, is whether the federal government should be engaging in this type of activity in the first place. And I think certainly from a free market position, that is a very questionable proposition. So those are some of the things that the Trump administration is talking about in terms of advancing its agenda and making sure that it meets its promises. Unfortunately, there's a negative side to all this as well. And I'm going to talk now about the negative side of the ledger in economic policy for the first 100 days of the second Trump administration. So since the November election, despite the initial spike, which usually follows after any presidential election, All major market indices have fallen over the past 100 days. So the S&P 500, for example, is down about 3.3%. The NASDAQ is down about 4.5%. The Dow Jones is down about 5%. Now, all of that translates, as anyone listening this evening or watching this evening knows, anyone who knows this and who is invested in the stock market or has a 401k, they know that these reductions translate into smaller portfolios. And that is worrying people. Markets are down, and that means that Americans' wealth has declined over the past 100 days. We've also seen currency markets fluctuate, with the dollar's safe haven status weakening, I think primarily due to tariff-driven fears and concerns about general economic uncertainty. I'll come back to that later. But when it comes to economic growth in the first quarter of 2025 was, as we learned today, negative 0.3%. So growth slowed in the first quarter of 2025 compared to the last quarter of 2024. And it's also very clear that consumer and business confidence ratings are starting to crater. And I think, again, this is due to fears about trade wars and a great deal of uncertainty about the whole tariff game. So let's talk about tariffs. This is the big one. So I think we're seeing a lot of tariff-induced economic uncertainty. So you'll remember that very close to the beginning of the Trump administration, tariff announcements were made very quickly, including 25% tariffs on Canada, Mexico, and China. And that started significant market volatility. And that only accelerated on April the 2nd, 2025, or as President Trump likes to call it, Liberation Day, when a 10% uniform tariff was put in place, with tariff rates ranging, depending on which country you're living in, from 10% to 145%. And China, by the way, highest. Now, we saw that the administration introduced a 90-day tariff pause, and that sparked a rally in markets. But I think the ups and downs in the market that we're seeing reflect the fact that investor confidence remains very, very fragile. We're also seeing some of our economic institutions signaling worries about this. So, for example, the chair of the Federal Reserve, Jerome Powell, has warned that tariffs, if they go ahead on the scale and scope that the Trump administration is saying, it will slow economic growth. And they've already cut their forecast for the economy from growth of 2.1% to 1.7%. That's a significant drop. We're also seeing the administration engaging in things like exemptions from particular tariffs, such as for consumer goods that have to do with electronics or the cell phones that we use, as well as certain car parts. But of course, what this does is while it provides exemptions for particular industries, it also creates inconsistencies in trade policy. And this inconsistency is being compounded by the fact that President Trump says one thing about trade one day and tariffs one day, and then changes his position the next day. And we see different administration figures articulating different positions when it comes to trade policy and how they see this playing out. That adds up to a great deal of policy confusion, which creates uncertainty, which creates, I think, negative conditions for markets. So what are some of the fallouts of this series of tariff policies that the Trump administration has embarked upon? Well, in the first place, just as in the first Trump administration, China shows no public sign of changing its behavior, and has given no public sign of any real desire to negotiate with the Trump administration. Hopefully some negotiation will happen, but nothing seems to be transpiring at present. In fact, China has retaliated with tariffs upon the United States. It's also done things like suspend rare earth mineral exports. And that hurts important sectors of the American economy, like the tech sector. Tariffs have also started to raise consumer costs, with estimates suggesting that the policies at the moment are likely to cost households, American households, a lot more than the 1,277 average household cost that came from the first term tariffs. So prices, if these policies continue, will certainly go up. And we also might reflect on the fact that these trade wars with allies like Canada, like the European Union, like Japan, is weakening our economic partnerships, long-standing trade partnerships with countries who are allies, long-standing allies of the United States. So this is where you start to see some of the tariff policies of the administration having implications for foreign policy and American national security. As always, of course, the bond markets are an interesting reflection of what's going on. And I think at the moment they're reflecting declining US reliability, with investors starting to seek safer returns elsewhere. We're also seeing consumer economic expectations reaching a 12-year low. And that pessimism crosses the political spectrum from left to right. And perhaps most worryingly, for those who think about things like the political implications of tariffs, we're also seeing cronyism around tariffs beginning to emerge. Now, why is this the case? It's happening because more and more businesses are recruiting lobbyists to try and secure exemptions, and if not to get exemptions, to get subsidies to make up the cost of the tariffs. And the problem is, of course, is that cronyism of this type, like all forms of cronyism, it fosters deeply unhealthy relationships between legislators, officials in the executive branch, and of course, business. And when it comes to things like the DOGE cost-cutting exercise, we've seen aggressive agency cuts, including the effective dismantling of USAID, as well as the ongoing effort to basically shut down the Consumer Financial Protection Bureau. Many free marketers will welcome this, but they have run into significant legal challenges, and that has undermined the implementation of some of these policies. So we've seen, for example, some of the mass firings of people within particular agencies encounter legal obstacles, and in some cases, it's actually led to reinstatements, and that has created a lot of administrative chaos within the federal bureaucracy. Then, of course, there are other tensions, I think, which are associated with the first 100 days of the Trump administration, which have economic implications. So the president's public attacks on Federal Reserve Chair Jerome Powell, including threats of terminating his position, have raised concerns about central bank independence. Now, whatever you think of central banks, you probably want them to be independent. And when questions are raised about their independence, such as the executive branch effectively saying, we want you to go, and if you don't go, we'll get rid of you, and then walking back those threats, the problem, of course, is it can potentially destabilize long-term monetary policy and trust in the institution to do what it's supposed to do. As I mentioned before, many executive orders, including those related to tariffs and deregulation initiatives, have run into legal challenges, and that's led to incomplete policy implementation. And we're also seeing delays when it comes to Congress negotiating the fiscal side of things, including the whole issue of tax cuts, which the president made part of his 2024 agenda. That has in turn created uncertainty. And I'm pretty sure that if the president doesn't deliver on tax cuts this year, that will certainly cause him to lose a great deal of his authority, not just in the general public, but among many people in his base as well. So when we look at the overall administration's successes, I mentioned some of the deregulation things, I mentioned some of the announcements of new investments. These do reflect what the president said he would do, but their long-term impact, I think, is at best uncertain. So, for example, while $1 trillion in new investments sounds impressive, we have to keep in mind that many of these are speculative. They haven't been delivered yet. And of course, their deliverance will depend upon future economic stability, which I think at the moment the tariff uncertainty is steadily undermining. And when we see things like tariffs, the common argument we hear from advocates of protectionism is that they're intended to protect American workers. But we already know that some businesses have started to lay off people in anticipation of higher costs when it comes to tariffs. We're also seeing people starting to realize that the consumers are going to bear higher costs as a consequence of this. What's interesting about this is that this repeats the first term Trump administration's pattern when it comes to tariffs. In fact, the whole way in which the administration has rolled out the tariffs, announce, pause, contradict, announce, pause, contradict, contradict, pause, announce, etc. This all mirrors the first term trade policy mismanagement. And I think the long-term problem with this is that it undermines US credibility with markets, but also with American allies. Lastly, let me say something about the means by which the Trump administration is proceeding. Now, by my count, the president has signed at least 142 executive orders thus far. That comes from the American Presidency Project. Now, that number is more than any other president in their first 100 days in office. That includes, by the way, the first Trump administration, in which 33 executive orders were signed. Now, the majority of Trump 2.0 executive orders have focused on immigration, border security, energy, and trade. Now, that 142 number is important because we need to compare that to how many bills have been signed in the president's first 100 days. And the ground number is 5. The president has signed 5 legislative bills in his first 100 days. Now, to put that in perspective, that is fewer than any president in the first 100 days of an administration since Dwight E. Eisenhower in the 1950s. So by this time, as I mentioned before, in his first term, President Trump had signed 30 bills into law. So 5 today, this time. In his first term, he signed 30 bills into law in his first 100 days in his first term. So what does this point to? I think it points to a major problem. The problem is that many of the measures that are being introduced by executive order, including many of the good measures, could be easily reversed by an administration in the future. A future administration could suddenly come back and reintroduce, for example, DEI as a whole of government program. So this also tells us that for the most part, Congress continues to be a bystander on economic policy. Now, we are seeing some pushback when it comes to tariffs from Congress, from a combination of mostly Democrats, but also a few Republicans. But so far, very little has occurred in terms of Congress generating legislation. Now, one hopes, of course, that the Congress is working on the president's tax agenda, and there's some evidence that they are doing that, and that they will move forward. But I think there's 3 things we need to watch here very carefully. The first is that there are some people on the right, including Vice President J.D. Vance, who have spoken vaguely about higher taxes on the wealthy. Now, that's been dampened down by President Trump, and there are other people in the administration who are pushing back against that particular idea. But the fact that some people on the right, among American conservatives, think that higher taxes on the wealthy is a potential option for tax policy in the future, I think is reason for longer-term concern. The second thing we have to think about is a political one. The sheer narrowness of the Republican majority in the House. That is going to make passing something like tax cuts hard, not impossible. And I'm heartened by the fact that the Speaker Johnson is very explicit in identifying himself as committed to free markets. But let's keep in mind that a narrow majority is a narrow majority. And that makes passing legislation extremely difficult, especially if the Democratic Party remains disciplined. Third, we shouldn't forget about the Democratic Party. Looking at opinion polls right now, it's deeply unpopular, and that's very helpful for President Trump. There's very little evidence that the Democratic Party has undergone a rethink of its position on things like DEI as a consequence of its defeat in November. It's also clear, I think, that the Democratic Party is generally heading towards leftward-leaning economic policies. And economically moderate Democrats are presently having very little success in resisting this trend. There's even reason to be skeptical, I think, of some Democrats' embrace of free trade over the past 100 days. Figures like Senator Bernie Sanders, who have spoken in favor of free trade very recently, were not saying such things 5, 6, or 10 years ago. One gets the distinct impression that some Democrats are in favor of free trade because President Trump is skeptical of free trade. In other words, the Democrats' support for free trade, I think in many respects, is driven by domestic politics, rather than a Bill Clinton-like embrace of free trade because of a certain degree of intellectual conviction. So, to conclude, the second Trump administration's first 100 days has seen economic policy successes in advancing deregulation, especially when it comes to DEI, and making cuts to the administrative state, as well as to agencies that you might say are less than friendly to free market ideas. However, these successes have been accompanied by problems stemming from tariff-driven market chaos that's produced an economic slowdown and has injected considerable nervousness into markets. Legal challenges and inconsistent policy execution have further hampered progress. Now, of course, there may well be an opportunity for some type of reset around tax policy later in the year. But at the moment, the picture is deeply mixed. So in summary, I think the Trump administration's approach has delivered short-term wins, but it continues to risk long-term economic stability, with both public opinion polling, but perhaps more importantly, market indicators reflecting significant unease with the president's economic policies. And I think if this continues for the next 3.75 years, the economic outlook for the United States and for the cause of free markets more generally is going to be very challenging, to say the least. Thank you very much.
All right. Well, thank you so much, Dr. Gregg. That was a great summary of the last 100 days. I'm going to open it up to the question and answer portion of this discussion tonight. If you could, please use the question and answer button toward the bottom of your Zoom screen, and then I will have a full list of questions right in front of me. I will take one now that has been submitted. So it seems clear that President Trump has been doing quite a few big things this year, to say the least. But he spent quite a bit of his political capital fighting the fight on tariffs. What do you make of Trump spending so much of this capital on tariffs as opposed to his other goals, such as spending cuts, administrative state reform, and education reform?
Well, thanks for the question, Dave. It's a good one because it's very clear that the president is very committed to fundamentally resetting trade policy as it has existed in the United States since the end of the Second World War. After 1945, the United States consciously adopted trade liberalization as its way forward on trade. That was a relatively bipartisan position. But the president, I think, if you look at his entire political career and even before he went into politics, one particular consistency that has marked his thought is very much a commitment to protectionist policies. And I don't see him deviating from that. I think this is something he actually believes in. Of course, AIER is deeply critical of that, but there's no mistaking that the president is very committed to things like protectionism. But of course, he's using up a lot of political capital to try and push this particular agenda forward. And it's not helped by the fact he's what you might call his efficient use of political capital is not being helped by the fact that the rollout of the trade changes has been confusing, contradictory, and topsy-turvy, to say the least. And presidents, I think, particularly if you're someone like President Trump, who basically has, I think, 18 months to push through a economic agenda, especially when it comes to things like tax cuts, which I think a lot of people will be paying attention to, including many of the people who voted for him. If he uses up too much political capital fighting trade wars both at home and abroad, and with considerable sections of parts of his own party who remain committed to trade liberalization, any president only has so much political capital to use. And I think if he does this, if he keeps down this path, and if he invests more and more political capital in trying to fundamentally shift trade in his preferred direction, that's going to make it harder for him to get the votes that he needs in the Congress, particularly the House, to secure things like tax cuts. So at a minimum, one would hope that he is aiming to get the 2017 tax cuts maintained in place. I would like to see him to go even further when it comes to corporate tax and income tax. But at the same time, if you spend all your political capital on tariffs, you have less to spend on other things. I really do think that the idea of political capital is important because once you get into office, it gets harder and harder to renew. And he's essentially acting in this case as a one-term president. So if he puts more and more energy into the tariff side of things, I think there's a serious risk that some of the other things he wants to get across the line politically are going to get further and further out of reach. And I don't say that as someone who's thinking about this economically. I think that's a hard, cold look at some of the political realities that surround the way that any administration acts when it's choosing how to invest its political capital.
This question comes from another one of our guests. So what message does the 90-day tariff pause send to the public? Does this not make President Trump's stance appear weaker, or is this a slow back to a slowdown on the tariff increases?
Well, if I could read President Trump's mind, I suspect I could be a very wealthy person by speculating in the stock market. So I think the best way to think about this is the following way. The president, I think, fundamentally views himself as a deal maker. He reviews himself as a negotiator. And that's, I think, how he views his approach to trade policy. And I know that many people watching, they're involved in business, they're actors, and they know that in negotiations, you push for certain things with the full expectation that you won't necessarily get everything you want, and you try and extract concessions from other people. So the 90-day tariff pause could be interpreted as the president saying, okay, I've unleashed shock and awe upon the world as well as the American economy. Now I'm going to roll it back a little bit so people can think and reflect upon the fact that I indicated that I was willing to go down this particular path when it comes to protectionism. Maybe they'll come to the table to do a better deal than they otherwise would. So that's one way of interpreting it. Another way of interpreting it is that there are competing groups around the president when it comes to trade policy. You have people like Peter Navarro, who is very, very committed to trade, to protectionism when it comes to trade policy. There are others, I think, like the Treasury Secretary, Scott Bessent, who have at least presented themselves as viewing tariffs as a negotiating tool. I happen to think that tariffs are a terrible negotiating tool, but nonetheless, I think that's one position that's being pushed within the administration. And then you have others like the Commerce Secretary, Howard Lutnick, who I think advances very different ideas depending on what day it is when it comes to trade policy. You also have, I think, conflicts within the Council of Economic Advisors about the proper direction of trade policy. If you look at the list of people on it, there are people who are protectionists. There are also people who are free traders. So I think another way of thinking about what's going on in terms of the back and forth and the 90-day, and then let's see if he rescinds that in the future or he changes it with regard to particular countries. Another way of viewing it is people jockeying for influence over the president and how he thinks about these things and the concrete initiatives that he takes. So one way is to think about it is Trump as deal maker. The other way to think about it is Trump presiding over a administration that, for all its talk about fundamentally shifting trade positions, does contain some people who are more committed to trade liberalization, and that there's a fight going on in the administration, and this is reflected in some of the inconsistencies in some of the things that the president has said about trade policy over the past 100 days.
So, another question from our audience. So, if Trump is successful with extending the tax cuts, what is the potential that the impact on the debt could actually be worse than failing to get these tax cuts extended or perhaps even made permanent?
So if the president gets the tax cuts through, and we still don't know precisely what that's going to look like. At a minimum, I think he wants to keep the tax cuts of 2017 in place. If he gets the tax cuts through, then as I think a free market person would say, well, that will actually, in the long term, produce more revenue because we'll have a more productive economy, we'll have more productivity, more growth, etc., and that translates into greater revenues for the federal government. But there's a fly in the ointment, and the fly in the ointment concerning the public debt is, of course, spending. That is the thing that has to be cut. Increased revenues that I think would proceed through tax cuts are great. They will have an impact. But I do think that we do need substantive cuts in spending if we're going to get the public debt under control. And that's going to be very difficult because, as I suspect virtually everyone who's listening to this webinar knows, most of the spending of the federal government now is on things like welfare programs. It's on entitlement programs. It's on Medicare and things like that. And the president has said that he's not willing to touch those programs. That's one commitment I think that he's made to a section of his base that are very, very resistant to any cuts to welfare or entitlement programs more generally. So yes, I think that if revenue comes in as a consequence of tax cuts, that's great. I actually would think that that would happen. But I also think that unless there's substantive cuts to spending, and I mean real cuts, not just slowdowns in the rate of increase in spending, which is how some legislators typically talk about this. But I do think if there are efforts to cut spending, they're going to run into huge opposition. And not just from Democrats, there'll be some Republicans that will oppose it as well. So that, I think, is the dilemma that the president faces. He's promised part of his base that he's not going to engage in spending cuts. And I don't see a way to substantially reduce the public debt without that. I do think you can grow your way substantially, but in the long term, I think the entitlement legacy is so big that the only way to deal with that in the long term is tax cuts plus spending cuts. And that's a very difficult combination to sell.
So, how would you respond to the administration's claims that the US has been, quote, ripped off by other countries for decades? Is it true that many other countries have levied much higher tariffs, and I'm going to add trade restrictions, on America than we have on them, putting the US at a real disadvantage in many of its trade relationships?
Well, it is true that many countries have higher tax levels on us than we have on them. That's certainly true. But we have to keep in mind that tariffs hurt the countries implementing them as much as they hurt the countries that they are directed at. So when China directs tariffs against us, we have to keep in mind that those tariffs translate into greater a lack of increasing lack of competition in the Chinese economy. It also translates into consumers in the Chinese economy paying higher costs than they otherwise would have to do so. So when countries, here's the thing, when people levy tariffs against us, they are hurting themselves as much, if not more, than they are hurting the United States. That's the key thing I think that we need to get our minds around. It's like cutting off your nose to spite your face. So yes, tariffs on certain goods do hurt certain types of American exporters. That's certainly true when other countries do that to us. But I do think in the long term that countries that use tariff policies aggressively and have high tariffs against imports from other countries, they end up doing longer term damage to themselves. So it's very tempting. I understand the temptation for us to respond by jacking up tariffs on other countries that have high tariffs on us. But that, of course, would end up diminishing American competitiveness and making American consumers pay higher costs for goods and services than they otherwise would. So yes, there are problems with what other countries are doing to us, but us using tariffs as a response to that, I think, is a very counterproductive measure.
Challenging now. But Trump has said that long-term better trade deals with trade partners will strengthen the American economy. Do you see a long-term potential for significant wealth creation from better trade policies secured through these retaliatory tariffs? Or do you see the U.S. pushing other countries away and having reduced trade with us?
Well, I tend to think that the latter is the most likely scenario as a consequence of trade policies being adopted by the Trump administration. How do we know this? Well, we already know that some countries which have enjoyed a pretty mutually beneficial trade relationship with the United States, like Canada, like Mexico, are already looking for alternatives. So they're making the calculation that the Trump administration is headed by someone who's a committed protectionist. Uh, he says he's using these as a means of trying to do deals, but they're clearly concluding that they need to start looking elsewhere when it comes to trade. And that, I think, will hurt American exporters, but it'll also make cheaper imports for us not so cheap. So I think that's the more likely scenario that we're going to see. And I think we're already seeing that playing out with different countries that are reorientating their positions now on trade because they're making the calculation that in the long term, this is not necessarily about deals. This is about fundamentally resetting American trade policy. And when you reset American trade policy, you effectively reset trade policy for the rest of the world. And other countries, like all countries, will consider what is in their self-interest. And I think at the moment, some of them are making the calculation that they should be trying to diversify their trade in terms of looking at other countries with whom they can forge a more open, more flexible trade relationship. So I think it tends to fall into the second category that you identified.
Turning to our neighbors in the north, given the election of a liberal prime minister in Canada and Time magazine's most recent cover, what direction do you anticipate in the trade battle with our northern friends?
Well, that's very interesting because I think many of the people watching this tonight will know that President Trump, in the lead up to the Canadian election, said that he thought that Prime Minister Carney was someone that he could do business with. Now, Prime Minister Carney is very much a center-left politician. He's not as far left as Justin Trudeau. I think he's very much a technocrat who thinks about the world in technocratic terms. One doesn't get the sense that he's as committed to, let's call it the woke agenda that Justin Trudeau had come to personify. And President Trump has said that he thinks he can do deals with Prime Minister Carney, and he was very skeptical, ironically enough, of thinking that he could do deals with the conservative opposition leader. So while it's the case that the Liberal government has been returned, primarily, I think, because of many Canadians being upset by some of the president's remarks about making Canada the 51st state, etc. I think that both Carney and Trump will end up in some type of negotiation. I saw the cover on Time magazine as well, and it's true that Prime Minister Carney invoked a great deal of anti-Trump rhetoric during his election campaign. But he also knows that Canada has a border, one border, and that's with the United States of America. And so regardless of efforts on the part of the Canadian Trade Minister, for example, to try and find other partners to do trade with, at the end, there's a reality, and the reality is that Canada is next to the world's biggest economy. Trump knows that, Carney knows that, and I suspect at some level, they're going to work out some type of deal. Now, let's remember that traditionally has been, for at least since the 1990s, has been contained in what used to be called the NAFTA agreement. So let's see what happens. I think that Carney will find himself engaged in some type of negotiation with Trump. Trump has signaled that he's open to negotiation with Carney about trade policy. So if anything, I think that's one type of relationship that seems, at least on the surface, to be characterized by deep hostility. But there are these economic realities that will be bearing down on both heads of government's minds.
On a different note, this person asks, how are the growth of public debt and fiscal deficits going to play out within the current situation with the Trump administration?
Well, I suppose to reiterate what I said before, I think it's very clear that the Trump administration has said that it will not reduce spending on entitlements, on welfare, etc. It is true that DOGE is finding inefficiencies and fraud within the entitlement system. That's been a welcome development. I think many people have suspected that for a long time, but it's very clear that that's a reality. Whether that degree of fraud is as high as some people anticipate it to be remains to be seen. But what I think is very clear is that there are political commitments, the Trump administration, the president himself, but perhaps even more importantly, in some respects, looking ahead to the future, Vice President J.D. Vance has made in terms of saying, we will not touch these things. I think that that is something that we need to be concerned about, because what it means is that there is effectively a bipartisan consensus in the United States now regarding the untouchability of entitlement programs. And that is the major driver of fiscal deficits as well as our overall public debt. And until that is addressed, I fear that we're going to be stuck in a type of soft despotism situation of the type that Alexis de Tocqueville described when he tried to imagine how a free society might lurch into a type of serfdom. And that happens when you have legislators giving people what they want in return for people voting for those legislators. I fear that that's the situation we're steadily slouching into.
So I'm going to squeeze this one last question in, Sam. So we're going to have to be a little quick with it, but I think it's a really good one. Do you think that tariffs in their current form or in their potentially imagined form can shift global supply chains such that we are no longer as reliant on China as we were perhaps during the pandemic?
You know, that's an interesting question, because clearly when exporters and importers are thinking about how to reduce their costs, they think very seriously about the tariff level. So I think it's fair to say that the trade war between China and the United States is likely to reduce American exports to China. it's also likely to reduce American investment and an American presence in China, and perhaps vice versa as well. But here's the thing, that was already happening. That was already happening before we started getting into these trade fights. Why? Because I think the Chinese economy is in deep trouble. Its demographic collapse, I think, is sort of baked into the situation right now, thanks to their one-child policy, which has spectacularly backfired on them. They're using a lot of industrial policy. There's a lot of the economy now that is effectively more or less back in state hands. They've moved away from the policies that were embarked upon by Deng, and Xi has moved a lot of the economy back in a state direction. They have, as a consequence of their aging population, huge welfare and health costs on the horizons. So but I also think American businesses and others were leaving because property rights and what was a very fragile rule of law have basically disappeared, which makes it very difficult to do business. But we have to ask ourselves, where are they going? Where are they moving to? Well, they're moving to places like Vietnam. They're moving to places like Indonesia and Malaysia. They're moving to Japan. In other words, they're not necessarily moving their operations back to the United States. So if anything, I think the trade developments that we've seen will probably accelerate some of those trends that we're seeing in the way that exporters and importers think about their supply chains and how they manage them in a time in which we're moving away across the world from trade liberalization towards what is effectively economic nationalism.
All right. Well, that is all the time that we have for questions tonight, unfortunately. There are still several in the Q&A tab, and I will selfishly tell you that they will be fodder for future articles that I'm going to write. So thank you to everyone who came and submitted questions. I apologize that we weren't able to get to every single one of them. I do want to thank Dr. Gregg once again for spending his time with us tonight. It was a true pleasure to get to hear from you and to get to converse with you in this manner. And with that, I'm going to throw it back to Dr. Gregg for our closing remarks.
Well, thank you, Dave, and thank you for moderating so well tonight. And thank you for everyone who's watching for coming this evening. It's a great honor to lead an organization like AIER that's taking, I think, a leading role in defending liberty, free markets, and limited government at a time in which I think these things are really under siege in our country. So when I think about AIER, I think about our growth. I think about our research, which produces numerous books, white papers, explainers, and hundreds of articles and publications ranging from National Review to the Wall Street Journal. I think about the 3,000 media appearances in 2024. I think about the 553 students who went through our programs last year. I think about the 1,830 applicants we had for 24 internships last year. I think about the relationships we have with federal and state legislators. I think about the 6 meetings every month that we have with major journalists. I think of the lectures given by AIER people at universities ranging from the Harvard Business School to the London School of Economics. I think about the events and conversations like this across the country that are driven by AIER. So I really do think that our ambition to become America's premier classical liberal institution is becoming real. So I close by inviting you to visit AIER to browse our content, to learn how you can attend or even host, if you'd like, an upcoming Harwood Salon, and if you're inclined, to financially support our work. Thanks again to all our supporters who are watching, and I hope that tonight's program inspires all of you to get more involved with AIER as we strive to realize our founder's, his vision, Colonel Harwood's vision of a free and prosperous United States. Thank you very much, and good evening.